reminder that we love questions from the audience, so you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee. Good morning, everyone. Thank you so much for being here for episode 49 of the Meet Me for Coffee podcast. I'm your host, Samantha Jones. I am coming to you guys live from my home in Kansas City. So always love to hear where our listeners are tuning in from. We started doing that a few shows ago, and I love it. It's a great way to start. So if you guys are listening in today, love to know that you're here so I can say hi. Let us know where you're listening from and what you guys also have going on coming up, any events going on, any conferences, any networking. I think there's something going on with the Chicago Traffic Club this week. Maybe it was today for golf. And then the New York, New Jersey Traffic Club as well is doing like some golf tournaments. So I know there's a lot going on out there. Let me know if you guys are doing anything fun this week. And I also want to let you guys know that we have until this Friday to register to save lots of dollars on Manifest, the Future of Supply Chain, which is a huge conference. It's grown so much the last few years. They just announced an acquisition. And so they have been acquired by, I think Connective sold to Hive or another event company, but that's so huge for them. So congratulations to that team. And I have a discount code for you guys. It saves you $200, but the rate goes up on Friday. And so right now, if you guys use my discount code, which is in the comments of the show, and you register for the event, you pay $1,495. If you wait until the show and you make a last minute decision, you pay $2,795. Please don't do that. That seems like a big waste of money there when you guys can come with my code and hang out with me at the show and do some podcasting maybe there. Good morning to Erica from Arizona. Good morning, Carlos from Minnesota. Good to have you guys here. I am going to go ahead and bring in my guest. I'm so excited for this conversation today. It's so timely. I feel like I always get to have the best speakers on when there's just like a lot going on with data releases or news headlines. So I'm going to go ahead and bring in Phil and let him introduce himself to anyone who doesn't already know him. Good morning, Phil. Thank you so much for being here.
Good morning. Thank you so much for having me. My name is Phil Rosen, and I'm a financial journalist and a founder of an independent financial media company. So I was previously a senior reporter at Business Insider, where I wrote about markets and economic data and finance. And then a little over a year ago, I quit my job to co-found a media startup. and we publish a newsletter 6 days a week. It covers markets, stocks, finance, economic data, the Federal Reserve, all that good stuff. And it's been, an amazingly interesting few months, to say the least. And I'm very excited to share some of the things I've been observing today.
Absolutely. I find now these days that most of the people that I follow the most religiously, the things that I read the most, are a lot more like independent journalists now. I feel like that whole space is growing so much, and I love that people are really leaning into that, and we don't just have to rely on like a few. And I still follow some of the major media sources, of course, and keep up with some of that, but my Substack subscription list keeps growing, and that's been really fun space for me to grow in. So it's really cool that you've kind of stepped into that space and are helping expand the independent journalist sector in the economic space.
Doing my best. I read a lot of Substacks and independent reporting, and I think it adds a very dynamic layer to the media landscape. And it's an exciting space to be working in and building a business in as well. And I try to, for our newsletter readers, I try to bring a somewhat unique perspective on the financial data and markets, and hopefully readers feel like the views I share are a bit differentiated from what you'll get in a Bloomberg or the Wall Street Journal, something like that.
Yeah, absolutely. Well, good morning to Stephen. Good morning, Patrick. Atlanta, also representing here today. Oh, from Atlanta Transportation Club, Houston has an event on May 15th. Awesome. Cool, guys. There's so much going on. It's springtime, so everyone's doing like their golf events and getting all the like networking stuff going on. So it's a fun time right now. I want to start today by, you had an article that came out recently on consumer sentiment, and that's something that I have followed now for at least 12 months, I think, in my monthly truckload market update that I publish. And so when I saw your article and that headline, I was like, I have to read this, want to know what's going on, because I know that the consumer sentiment data has been basically really, really bad lately. Like everyone's feeling really negative, it seems, in these surveys. But I also know that we are kind of seeing some discrepancies in the soft data versus like what's actually showing up in our economic data. And so I'd like to spend some time this morning just taking advantage of the chance to pick your brain on that, asking you to kind of expand on that and tell me more about what we've seen developing in that space when we're talking about this consumer sentiment versus economic data and what that means for the economy.
Yeah, these consumer surveys have been around for a lot of years, and the recent consumer sentiment data, and we have that chart coming up. It's pretty much showing that everyone expects a recession to come, and consumers have been calling out this recession for several months now, but the hard data don't actually suggest the same thing. And so if you see the chart, consumer sentiment has tanked, but really it's become such a partisan survey. So if you look at the chart at the start of the Biden administration, for example, you could see the same partisan divide with Republicans going down and Democrats going up. The same thing has happened now, but it's flipped. And I think the survey we're looking at now, the Michigan Consumer Sentiment Index, I think it's down about 32% from a year ago. And then there was a similar chart, which we don't have, but the Economic Expectations Index is down, I think, 30% since the start of this year. So that's one of the worst drops we've ever seen on that survey. And we have a second chart, which shows the bulls and bears sort of investor index. And this is how investors are feeling about their, the optimism for the stock market, essentially. So you can see that the bears are sort of winning, let's say, in this survey. And I expect in the next week or so, this will shoot up pretty rapidly, but all year it's been very negative. So all this suggests that we should be in a horrible economy, and that's really not the case. A lot of it's, partisan feedback on the surveys, but it's also the surveys themselves have become less and less reliable as economic indicators over the last few years. And the Federal Reserve, they had a study in April they released. So this is coming from the Fed itself, right? And they essentially found that when looking at sentiment surveys tied to actual retail spending, there's very little connection there compared to years past. And there's a massive gap essentially between how consumers feel and then what their spending habits suggest about
Yeah.
what the real economy is doing. And the simple thing is Americans continue to spend, and they're spending more than pre-pandemic. And everyone says they feel broke and that the economy is turning a corner for the worst, but they're not acting like it. Their behavior says otherwise.
Yeah.
And then if you look at the hard data that the Fed looks at, right? So we have CPI inflation. We should have that chart as well. It came in at 2.3% annually this morning for last month. And inflation has dropped every single month this year, which is an interesting trend, right? And you see, obviously, President Trump has been very vocal about calling on the Fed to cut rates, which is an unusual role for the president to play because it's typically two separate institutions, and there's really no commingling with monetary policy and the executive branch. But Trump seems set in his belief that rates should come down. The Fed thinks otherwise. And the tariff wrinkle is certainly, no one really knows what that's going to do as far as the long-term effects on inflation. But the Fed seems to think, okay, inflation could come up again, so we're not going to move on interest rates. But every single month this year, inflation has come down. So
I think that there's like various measures of looking at inflation data, right? Because I see a lot of commentary around that. And I think CPI is one that's pretty widely like used and respected. So I know that it seems like maybe we've shown certain places where inflation has been kind of like sticky is the word that we've used a lot. But overall, it seems like while consumer sentiment has continued to decrease, inflation hasn't actually been like notably increasing, right? It's decreasing by many measures, but it just seems like that those two are completely opposite each other right now, the inflation data and consumer sentiment.
People feel like things are getting worse, but prices are accelerating slower than ever, or at least in the last recent history, right? Since the last 5 years or since pre-pandemic. And if you look at the data in the labor market, like monthly jobs added, for example, and we have that chart coming up, the labor market is also more resilient than people expected this year. So you can see monthly job growth has not fallen off a cliff, right? And you could say there are lags to this data, and that's possible, but it's the same. It's the only data we have to look at this stuff.
Sure.
So this also suggests that the economy is not going into a recession, at least today. And again, this clashes so hard with what the sentiment surveys are suggesting. But then you take the sentiment surveys are extremely negative. You take the Fed study, which found that the sentiment surveys we can kind of toss out for now because they're not indicative of how the real economy is doing. And then you have the real economic data, which is showing that things are holding up quite well. So that's sort of the lay of the land right now. And then the wild card, of course, which is why people are so uncertain, would be tariffs. And this is a fairly unprecedented policy rollout, let's say. And we know we're going to get probably more trade deals, but maybe some countries won't do some trade deals. So we're not really sure how that can pan out as far as, what the trade economic order will look like in 12 months from now. But as far as the health of the economy, I don't think it's as bad as some of the sentiment surveys are pointing to.
So I know that one economic data point that's been really struggling, and you also wrote an article about this that I cited in my newsletter that I released last Saturday. It was Saturday morning. Was manufacturing. So PMI is taking quite a big hit, and we've seen from various, like you cited the Dallas Fed Reserve release, I think, on Texas manufacturing specifically. And we've seen a lot of weakness in domestic manufacturing markets so far this year. And so how does that kind of play into any of these decisions on, what the Fed is maybe considering right now. I guess how important is American manufacturing overall when we're looking at the economy and taking into consideration interest rates or inflation or things like that? Does it not factor in as much as, looking solely at labor market health and inflation? Does the Fed have any responsibility to care about American manufacturing industries, and to what extent?
Yeah, I think so. To be clear, I'm not a manufacturing expert by any means. I write about it on occasion, but not as much as I write about inflation or the stock market, let's say. So that's one caveat I'll start off with. But yeah, the Dallas Fed did a survey in I think it was April, and it was their most recent manufacturing survey for local leaders in the manufacturing sector, so like business executives, small business owners, things like that. And a lot of these comments they got from these business leaders were saying, hey, we need the Fed to cut rates because business conditions are tight for us in the manufacturing sector in Dallas or Texas. So, I know we just mentioned how sentiment surveys are not that reliable anymore. And maybe it's true, maybe it's not with this Dallas Fed survey, but because it's the Fed's own survey, we can sort of assume the Fed will pay attention to it, right?
Okay.
So maybe however much credence they give to the Michigan survey, I don't know, but the Dallas Fed survey is an internal project that has been longstanding, many years going. I would guess they're paying attention to it. And yeah, you had shipping numbers fall, general business activity went down, and I think their uncertainty index for manufacturing executives, that jumped by a huge margin. So these things it's more sort of color for the Fed to make its decision on.
Yeah.
And, it's hard to know how much they will weigh this manufacturing survey. I don't anticipate they're paying attention to it as much as, say, inflation or the jobs market. But at the same time, the Federal Reserve, it's a very, very difficult position to be in because the structure of the institution is backwards looking. So President Trump has been calling Jerome Powell Mr. Too Late, but that's been the Fed forever. It's not Jerome Powell. It's just the institution is set up that way where it has to rely on backwards looking data. And I don't fault them for that at all, because if I was in Powell's shoes, I don't know if I would be able to make any different decisions, because they're looking at the past, right? And then you have pretty much the news and the public is trying to look at the future, and you have investors looking at the future. So monetary policy is sort of always at odds with what broader consensus is pointing to, because we're looking in different directions. So I think the Fed is in a very tough decision, and even
maybe more so now than ever, because the word uncertainty is like being used in every single quarterly earnings release that's coming out right now. And so,
it is crazy.
I mean, if nobody knows, everyone's uncertain for something as critical as monetary policy, and the risk that they would take to get it wrong, to act too soon. I think that it's something that, from what I've observed, they're just not willing to take that risk, and they're continuing to behave, like you said, as they have historically, looking at the data, the actual data that's coming in and being available to them, which, again, with sentiment being so far off right now, I don't really know that, all the emotion around the market and can help them make a decision. And also, I wondered that too about your the Dallas, Federal Reserve release, and they're calling for rates to be cut as a stimulus, essentially, to certainty or optimism, I think.
Sure.
And I think that potentially, and correct me if I'm wrong, tariffs could potentially be another way to help stimulate some optimism. So I think the Chinese tariff update has been a big relief for a lot of companies and for a lot of consumers too. And so I know we're not like completely, we have a pause, but it's a 90-day one at least. And so I think seeing progress on the tariff front is helping to bring a little bit more, I don't want to say certainty, but just like a little smoothing some emotions right now across business leaders and consumers as well. So maybe, the call for interest rates to be cut is almost not that that's the only way to achieve a means to an end, but it's like that we just needed something to help kind of stop the trajectory of cynicism that we were all experiencing.
Yeah. So this weekend, we had the US and China come out with this trade deal that was essentially a pause on tariffs, right? As you mentioned. I'm not sure if you look at the stock market absolutely skyrocketed to open on Monday morning. And the S&P 500 is actually now positive for the year as of today, which is a ridiculous thing to say because it was only a couple weeks ago. You had the Wall Street Journal saying we're in a new Great Depression. And, there was a lot of sort of doomer headlines. But investors, suddenly they get a glimpse of daylight as far as clarity on what's coming next. And I think that's why investors have reacted so strongly right now. It's not even so much investors are cheering for tariffs. I think they're just cheering for, okay, now we kind of have some indication of where the future is headed. So it's more clarity than, let's say, optimism on tariffs is what I would say. Because I don't know if anyone really has a grasp on what tariffs mean for the economy or the long-term relationships we have with other nations. But it does suggest we have a clearer path forward as far as what to expect for investors. And that's really what I focus on in my reporting is how markets respond to everything in the world. So I'm not a tariff expert by any means. I've been writing about how markets have been acting in response to tariffs, Trump's tweets, meetings with China, all this stuff. And everything is very fast moving and very dynamic right now. And the second, obviously, I think markets have been starved for some sort of certainty. So we haven't gotten that for a couple months. And then as of this week, we sort of got a green light on, okay, here's something that we can point to that looks like it's going to happen. And that's, this trade pause with China. And
would you say that before they were starved for some sort of certainty, that they were also kind of starved for some sort of opportunity too, though? Because it seems like markets were strong, right? They have been strong for a while, but there's a lot of investors out there who like to use dips in the market as strong investment opportunities. And we didn't have a lot of that for like a couple of years, I think. You think that this also provided, like, given that it was such a short-term dip, did we see a lot of people willing to gamble on that and invest into the markets?
Yeah, I don't have the data in front of me, but I did read a lot of reporting on how retail investors really piled into the dip. So in the last couple months, retail was a net buyer, I think, at least more than institutions were. So I think a lot of institutions were selling and retail was buying. So I think that's the opposite of what we saw at the start of COVID when retail was selling and institutions were buying. So I'm not really sure the dynamic behind that, but that's what we observed. And yeah, these the long-term trend in markets has always been up and to the right. And things can change, and past performance doesn't mean future performance. But I do think that a lot of investors that panicked and sold with Liberation Day and sort of the tariff uncertainty, a lot of them are certainly kicking themselves today. And maybe they're wondering, okay, why didn't I hold on for these few weeks? Because a few weeks in a 30-year investing time horizon is nothing. And it's I saw Warren Buffett at his annual shareholder meeting this year. He said, if you can't stomach a 15% gain or loss in the stock market, you probably shouldn't be in the stock market. And that's I think that's really wise advice, because the price of being in the market is the volatility, right? That's like the tuition you pay. You have to stomach the ups and downs of markets. But the long-term returns are extraordinary, and they've always been extraordinary in U.S. capital markets. So I think it was a lot of short-term thinking that came in when people saw Trump's tariffs and maybe Trump's, he has let's say a very unique leadership style, and it's pretty unpredictable and erratic. but that's not a reason to bail from markets. I don't think
Sure.
it's not justified. We haven't seen evidence historically that one president can have such a radical long-term impact on capital markets. And I don't think, as historic a guy Trump may be in so many ways, don't invest on who the president is. That's like
Yeah.
a very, timeless rule. And markets will generally go up most of the time over the long run. And if you're trying to time the market as far as what the executive branch is doing, you can't really win that. You might get lucky here and there, but long term, you're not going to win that guessing game.
So I do have a question for you, because this is way more your domain than mine, and I won't pretend to even probably know the basics well. But I've been reading a lot about bond yields, and I'm curious to know a little bit more about. We talk a lot about stock market, the S&P, but what's going on with more like these long-term yields and bonds? And I've heard that there's a little bit more cause for concern in that space, but what does that even mean? Like what is the concern around, and how do these bond yields affect like the overall economy?
So the bond market really is people look to that as a better indicator of the economy than the stock market generally, like markets folks, I would say. And the stock market is right now extremely optimistic about what the future holds, because everything is going up. And it's you could say the stock market assumes that business conditions will be better later than they are today, and that's why every stock is ripping today and yesterday. However, bond yields remain fairly elevated, and so someone just dropped a comment that bond yields are a big deal, and that's why he backed off the trade war with China. To a degree, that's true. And I think Trump said it must have been the first or second week of April. He said bond traders were getting jittery or queasy or something like that. And there was some pullback on tariff policy because, the president and those around him, the Wall Street guys around him, know that if the bond market is saying uncertainty is ahead, you kind of have to listen to that more than you do the stock market. So right now, bond yields are still elevated, and that reflects essentially economic uncertainty. So we're not out of the woods as far as, okay, a lot of smart money still don't know where the economy is going. And I think that's totally fair to say. The stock market, it's, I don't know if it's fair to say that it's a more sentiment-driven machine, but right now it's way more optimistic than the bond market. Even if you just look at this morning, the benchmark S&P 500 is now positive on the year. That's a crazy thing to say for someone that's been writing about the market every single day all year, because on many of those days I was writing this newsletter, it seemed like, all the interviews I was doing, the reporting I was doing, people thought it was the end of the world for investors. And clearly that's not the case. But I will say the bond market, they are not so susceptible to news headlines as far as they have a higher bar to clear as far as convincing that things are going to be in the clear.
And so what would be some of the like potential, I guess, consequences or effects of the current, trends in the bond market continuing? Is there an impact? Like what happens if nothing changes, and what changes would be preferable? Like what happens if nothing changes, but what are we looking to? Like what would be best case scenario for the economy?
Yeah. So the White House has said for a few months now that they are focused on the bond market, essentially like treasury yields. And they want to get that down because I think their long-term goal is really to lower borrowing costs across the economy.
Yeah.
And that, that's I think that's a very simple place to sort of leave it at that. They want lower borrowing costs for everyday Americans, which is, that's certainly a good ambition. It's very difficult to do from the White House, I would say, because the Fed really has a huge input to that. And, that's why Trump, for example, has been so adamantly calling on the Fed to cut rates. And the Fed is stuck to its wait and see approach, and which I think there's a case to make that that's the right move right now. But it's the bond market is saying we're not in the clear yet. That's really what the messaging is.
And if we don't see any reduction in yields in the bond market, what does that just mean? Probably higher interest rates longer, more of a suppression on economic activity, or what could be some of the potential consequences of that?
Yeah, it's a good question, and I'm not sure I have a super cohesive answer to that. But I would say for now, it does seem like um, market investors, as far as stock market investors, are not paying attention to bond yields that much because stocks have, this week is a case in point. Stocks are going a lot higher, but bond yields aren't really moving that much. So the economic uncertainty in one is not being reflected by pessimism in the other.
Have we seen this before? Has this happened like historically where we can like compare, current markets to previous, or is this kind of more uncharted territory?
There's always times in history you can point to that mirror one another, I would say, and I don't have it in front of me, but if I had to put money on it, I would say we've seen something in these conditions before. But I do think what's unique about this moment is this reordering of global trade, and that's
Yeah.
something that hasn't really been attempted in modern history. And I think that's why we've seen such volatility in markets, because markets are investors, and investors don't really know how to best position for something like this. So Trump is doing a lot of things that people haven't done before, at least in our lifetimes, and that's hard to sort of position for. So sure, maybe we've seen some of these market patterns in the past, but as far as the catalyst being one guy's ambitions to reorder global trade, that's a new one, at least for me.
Yeah. I think plenty of opinions out there, cynicism, skepticism, whatever you want to call it. But I would say that in thinking about this and studying all the tariffs, and when we actually consider what seems to be more like the long-term goals that the administration hopes to accomplish, I can't almost imagine trying to have done this like one country at a time, like change this. Like it just seems like such a large amount of work to get done that this was almost like a ripping off of a band-aid, maybe something bigger than a band-aid, like it's just something much bigger than just a band-aid. But it's like it just seems like it was an approach to go at it all at one time to see how quickly it could all be done. And I think that there was a lot of early warnings too from different people in the current administration that was like, you need to expect some short-term disruption and pain from this. And so I think that's what remains to be seen, right? Is if how short-term is short-term, and are the disruptions something that take longer to climb back out of than we anticipated, or are they going to be more severe than we anticipated? So
Yeah, and
still waiting.
I don't really have I'm not sure if this is the way that would have been the best for, steering the economy in a predictable way.
Sure.
But at the same time, something like this at this scale has not been really attempted before. So it's not like we have a blueprint on how this
Yeah.
should go.
Yeah.
So I think that's one thing to keep in mind. But yeah, investors have certainly been on a roller coaster. We have no idea how to respond to these policy ideas and rollouts and pullbacks. So, but generally, I think markets are optimistic because markets believe generally that things will get better. And I think we're seeing that play out right now.
Last question for you, just in general. A few months ago, the odds of a recession were increased quite dramatically, and they were kind of hesitant and like slow to lower those back down. Even like a month later, when some better data came back, I haven't checked to see if they've since been lowered, but in general, there's still quite a few people out there worried about recessionary risks. Um, is anything that you're seeing, cause for concern that might be a more likely trajectory, or just any thoughts, any comments on recessionary risks?
Yeah, I think so. Goldman Sachs, they raised their recession outlook. I don't remember. It might have been to like 45% or 50% last month, and then yesterday they lowered it by like 10 or 15% based on the China trade deal. So these things, they they move quite a bit in the short term, which I think makes these predictions kind of useless in the long term because they're always going to fluctuate, right? Based on the firm that's making the call and based on the headlines that are topical that week. So I don't know if it's that useful to look at these recession odds or recession predictions from Wall Street firms because they change so much in the short term that they really have no predictive power. And so I think it's, and I'm not a economist by any means, so I'm
Yeah.
not trying to forecast one way or the other. But I try to look at the data, and that's what informs my reporting. I speak with a lot of people who are way smarter than I am, so people in markets, investors, economists, strategists, and and they try to point me in the right direction, I would say. And generally, no one has been super bearish on the economy that I've spoken with recently. So people, I think, are generally thinking, okay, we're going to have a lot of near-term volatility, uncertainty, and after that, we'll see. But I think the long-term sort of bullish outlook remains intact.
Awesome. Thank you. Well, if we have any questions from the audience, that would be fantastic. I'm sure somebody has some type of question. We tend to have a shy audience these days, I suppose. But if anybody wants to ask any questions, we would be excited to ask them. If anyone listens back to this after the live event has already ended, we'd still like to hear your questions. You can leave them in a comment and on the LinkedIn event and tag Phil or tag myself, and one of us will see that and get to that. We'd love to still answer those questions. Before we wrap up, Phil, I'd really like to have you tell people more about how they can follow your work, connect with you, subscribe, because like you said, you have an awesome newsletter and you have some publications that are coming out on a daily basis. And so tell me a little bit more about like who those would be for, what they could expect to, learn from these and how they can subscribe.
Yeah, so I write, my company's called Opening Bell Daily, and we publish a flagship newsletter every morning, and it's free to subscribe. And that's what I write. That's what I edit every day. And it's based on a lot of interviewing, a lot of research, a lot of data. There's always a bunch of charts in the newsletter. It takes 5 minutes a morning to read. Highly recommend you subscribe, and I would appreciate it if you subscribe. And if you use the Bloomberg Terminal, you can also find Opening Bell Daily on Bloomberg Terminals every day. So depending on where you get your financial news. And I'm on LinkedIn. I'm very active. I post a lot of video content, written content, newsletter stuff. So I'm very searchable online.
Awesome. Definitely recommend that everyone connect with Phil, subscribe to his newsletter. He's right. It is not like it takes a very short amount of time to read. It's not like mine. It's a lot longer, but that's only once a month in my defense. So he has a really digestible newsletters that have a lot of great information. And for all of my supply chain and logistics folks, yes, it is stuff that will be applicable to you. It's definitely been useful for me in navigating our industry and the broader markets in general as well. Phil, thank you so much for coming on the show and making some time to be here today. And then, sorry, we just saw a question come
Yep.
to check on a couple of these questions. What will the 90-day tariff pause with China do to freight volumes? Will this lead to a rush of orders and a spike in freight rates? I'll take that one real quick, Chris. We're still getting the really preliminary data in on that, but I was trying to look at it this morning. Journal of Commerce just published a piece. I saw a couple others out there, and they said that there's already been a surge in bookings and that the issue is going to be a bit of a capacity crunch because the container ship lines, the vessels, have been adding blank sailings and removing ships to, as always, play with that supply and demand balance so that rates didn't have to go so low. And so we had a lot less capacity in the market right now from actual physical space on ships. So now everyone is trying to basically get that space first to get bookings put in. Some things I don't know, if anyone listens to this and knows, is are there penalties for canceling bookings for shippers? So is it like we're going to see a rush to get all these bookings made? And then if things were to change, like tariffs don't pause or something reverses or new developments come out, will they cancel those? I don't know. But right now, preliminary data is showing that there is definitely a push to get more imports brought in right now. I also wrote in my recent newsletter that we had like a 60% increase in pharmaceuticals and like a 40% month over month increase in computer and electronic imports in the last pull forward. And the sources I was citing on that said to not expect that to have been a one-time trend, that we're expecting to see a lot more pharmaceuticals and a lot more computers continue to come in this month, next month. And so certain industries, maybe more than others, are still definitely going to take advantage of this 90-day pause. Sorry, also going to read Bella's. I hope that was helpful, Chris. If I see any more articles, I'll send them your way. You mentioned earlier something about consumer spending still being high, even though there is a bit of a negative outlook. Do you think this is because consumers have adopted a habit of overconsumption? I'll let Phil take this before I give my opinions into this matter.
Yeah. Bella, that's a great question. Thanks for asking. And it's certainly possible. Americans are prone to overconsume, I would say, and continue spend. I don't have a data-backed take on that, I would say, but generally, Americans consume, and that's what this economy is built on, is consumer spending.
Yeah, I would say that there are hopefully certain sectors of our overconsumption that can kind of calm down, like more in the Temu, Shein type of verticals, where maybe those are going to struggle to be a little bit more affordable because of tariffs. Even the reduced tariffs, I think, are still like a 20-something% increase on a lot of imports, and those would not be in excluded sectors. So I think maybe we would see some shifts in consumption in certain spaces like that. And then I think there's been some trends in like changes in discretionary spending, not a lot, but like a little bit more awareness as consumer sentiment has changed. And then as always, I've also, seen that the lower income classes are going to be most susceptible to tariff increases and things of that nature. So maybe we see subtle shifts, even like during the pandemic, we saw shifts from Kellogg's brand cereal to like Great Value brand cereal. So subtle things like that, where you're still going to consume the same amount of boxes of whatever it is, but you might start shifting brand preferences in favor of a couple of dollars. So things like that maybe. But overall, we seem to be a consumer-based economy, and we don't seem to want to have a desire to slow down on our consumption. My thoughts. All right. Awesome. Great questions, guys. Again, if anybody else thinks of any questions, please tag us. We would love to see those. And Phil, it was a pleasure having you on today. Thank you so much for making the time to talk to me.
Thank you, Samantha, for having me. It was a blast.
All right. Thanks, everyone, for meeting us for coffee.